Everyone, welcome back. Tyler Lavoie here, financial planner. So this is video 2 of the series. In the last video, we talked about how retirement taxes actually work. Today, we're going one layer deeper. So we're going into a specific strategy that most people in their late 50s and early 60s aren't thinking about yet. And if you have most of your retirement savings in a traditional IRA or a 401k or any type of employer plan, this one is worth your attention. And so here's a way to think about what's sitting in your traditional IRA or your employer plan right now. That account balance you see, not all of it is yours. A significant portion of it belongs to the IRS. They've been deferring their claim, but haven't given up yet. Every dollar you withdraw gets taxed as ordinary income, and starting at 73, they start telling you exactly how much you have to take out. And the more that your balance grows, the more control they have over your tax bill in retirement. That's the problem this video is about. And so there's 3 different types of accounts in retirement from a tax perspective. You can think of them as buckets. So there's the taxable accounts. Think of brokerage accounts and savings. This is where you pay taxes on gains and dividends as you go, but there are no required minimum distributions. Then there's the tax-deferred bucket. So these are your traditional IRAs and employer plans. This is where the money grows without taxes, but every dollar that you take out comes out as ordinary income, and RMDs start at 73. And then finally, there's a tax-free bucket. This is your Roth IRAs or Roth 401ks, where growth and qualified withdrawals are completely tax-free, and there are no RMDs on these accounts. Most Americans who've been diligently saving in workplace plans are most commonly heavily concentrated in that middle bucket, which sounds like a good problem to have until you understand what it means for your tax picture in retirement. And so the big issue with overconcentration risk in tax-deferred accounts is this. Every dollar in a traditional IRA or a 401k has a silent partner. When you withdraw, you pay ordinary income tax on the full amount, not just your gains, all of it. And once RMDs begin, the IRS tells you a minimum withdrawal that you need to take if you need the money or not. You do not have a choice. And as your balance grows over the years, those RMD amounts grow with it. Retirees who don't plan for this sometimes find themselves in higher brackets in their 70s and 80s than they anticipated. And it's not because they spent more, but because their account balance did well. And so tax diversification is really having money spread across all 3 buckets, gives you the flexibility to draw from the most efficient source at any given time and year, and that is the goal. And so what is a Roth conversion? A Roth conversion is a straightforward, it's more or less straightforward in concept. So you move money from a traditional IRA or an employer plan into a Roth IRA. In the year you convert, you just pay ordinary income taxes on the amount moved. So you're paying ahead of time. And so from that point forward, those funds grow tax-free, and qualified withdrawals from retirement are tax-free. There are no income limits on conversions, and anyone can do this at any income level. The way to think about it is this. A Roth conversion is prepaying your tax bill to remove that IRS claim on the money down the line. You're choosing certainty now over uncertainty later. Whether that trade makes sense depends entirely on your situation. The years between that are best to do this is early retirement and before RMDs start. And these are often the lowest income window of your latter life. So you may have retired early, your Social Security may not be fully in play yet, and then the RMDs haven't started, so your taxable income for maybe the only time in your overall life cycle is relatively low. This could be the lowest moment for you, and that's the window. Because if you're going to do a Roth conversion, this is the most favorable time because you're at a lower tax rate than you pay on forced RMDs for income later. That window would allow you to actually fill that bucket, which we'll talk about it in the next slide here. And so the approach that I'm talking about is bracket filling. So you figure out what income you'll have from the other sources. This is from part-time work, Social Security, a small pension, and then just convert just enough to reach the top of your target bracket without crossing into a higher one. This is, in this example here, you can kind of see, and this is for 2025, but you can see a couple with $40,000 in income, they can convert up to $56,950 and stay within that 12% bracket. And so one thing to keep in mind is Roth conversions add to your income. And there are Medicare premium surcharges called IRRMA that do kick in on certain income thresholds that you need to be aware of. So you want to consider all this in the context of your full picture before you decide to pull the trigger. And so there are pros and cons to anything in life, and this one here has a few. So on the benefit side, you're reducing future RMDs, you're providing yourself tax-free growth, and no RMDs, the potential tax savings for heirs, and some protection against future rate increases. These are pretty good pluses. And so on the consideration side, you're paying taxes now, which kind of stinks, but requires you a little bit more cash flow, and you're using funds outside the IRA to cover that tax bill. And so using IRA funds for the taxes themselves actually reduces the benefit of doing this. And so if you expect to be in a significantly lower bracket in retirement, the math may not favor the conversion. So this isn't a one-size-fits-all approach, and really the right answer depends on you and where you're currently at. So to try to make this a little bit more concrete, here's a hypothetical illustration scenario. So consider a $200,000 traditional IRA. If it's left alone, RMDs starting at 73 will force roughly $7,500 in taxable withdrawals in the first year, growing each year as that factor changes. Now remember, that divisor number gets smaller, so they start taking out a bigger chunk. And alternatively, if you decide to convert $30,000 per year for 8 years during the early retirement window, this removes $240,000 from future RMD calculation for you, which then would potentially reduce the forced income in your 70s and beyond. The overall principle is this: acting during the window gives you options. Waiting until RMDs begin removes the options for you. So a lot of people, they're always concerned about what are some mistakes, but let's talk about the misconceptions first. So, the first and foremost, more isn't always better. Converting too much in a single year can actually push you into a higher bracket or trigger those Medicare surcharges I was talking about that really wipe out the benefit. Second is using an IRA itself to pay the tax bill, and the conversion reduces that long-term value that you're going to get from it. So ideally, you want the conversion, these taxes that you're going to be paying, you want to pay them from savings outside your retirement accounts. And third, waiting until 73 to think about it really means the window is already closed, and the time to evaluate this is now, not later. And so to kind of summarize, and the key takeaways I want you guys to have is most pre-retirees are heavily concentrated in tax-deferred accounts, meaning the IRS has significant claim on their savings. A Roth conversion moves money from the tax-deferred bucket to the tax-free bucket, but you're paying taxes now at potentially lower rates than what it would be down the line when those RMDs kick in. And so the window for this begins before RMDs start. And the right amount to convert is highly individual, so it really depends on your income, your brackets, Medicare thresholds, and the overall plan. There's a lot of factors. In the next video, we'll talk about it more in the third piece of the series, the right order to withdraw from your accounts and why sequence matters more than most people realize. And so if you like to really talk through, and you feel like this is a lot of information and you want to find out whether a Roth conversion might make sense in your situation, I'd really invite you to book a complimentary retirement readiness chat. The chat itself takes 15 to 30 minutes. There's no pitch. It's just a conversation to see where you are really weak at and where things could be improved and where you stand. My name is Tyler Lavoie. Thanks for watching the video, and I'll see you in the next one.